Nature of accounting. Advanced Accounting 12th edition by Batliboi. Advanced-Accounting-Shukla Agrawal. Advanced Accounting by S.P. Jain, K.L. Narrang, Gupta and Soail Afzal. Accounting is the language of business. Transaction records during accounting period for view to prepare financial statements. Important objectives. Measure profit of the business. It is done through the preparation of profit and loss account. Ascertain financial position. It is done through the preparation of balance sheet. These are designed periodically, usually once a year. Definition of accounting. American Institute of Certified Public Accountant. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and event, which are in part at least of financial character, and interprets the result thereof. Thus, accounting is an art of recording, classifying, and summarizing in terms of money, transaction and events of a financial character and interpreting the result thereof. Accounting cycle. Recording transaction in subsidiary books, classifying data by posting them from subsidiary books to the accounts, closing the books and preparation of financial accounts. Function of accounting. Keeping systematic records, protecting properties of the business, communication the result, meeting legal requirements. Necessity of accounting. Businessmen want to know the type and amount of earning, the amount of profit or loss if any, the amount of capital and size and causes of increase or decrease, the nature and value of asset possessed by the business, the nature and value of liability, customers balance, returns, sale tax, income tax, suppliers balances, type and amount of expenses. Group interested in accounting information. Owners, creditors, managements, researchers, government, employees, investors. Generally accepted accounting principle, GAAP. Financial statements are to be prepared in accordance with generally accepted accounting principles. Unlike in the past when business accounts were largely needed by the proprietor, today accounting statements are needed by the various groups such as shareholders, creditors, investors, governments, and others. In view of the utility of accounting statements to various interested parties, it is necessary to have a uniform and generally accepted approach to the recording and reporting of business transactions. Hence, the need for using a standard language which everyone can understand in the correct perspective. It is with the view to evolve a standard accounting language. The accounting bodies and the authors of accounting textbooks have developed over a course of time certain generally accepted accounting principles, alternatively called as concept, conventions, and postulates. Kind of accounting principles. Concept and conventions. Concepts are used to connote the accounting postulates, necessary assumptions, and ideas which are fundamental to accounting practice. Conventions. The term convention is used to signify customs or traditions as a guide to the preparation of accounting statements. Accounting concepts. Business entity concept, dual aspect concept, accrual concept, cost concept, going concern concept, accounting period concept, money measurement concept, revenue recognition concept, the matching concept, accrual concepts, objectivity concept, business entity concept. It is very important to note that for accounting purposes, the business is treated as a unit or entity apart from its owner, creditors, and others. In other words, the proprietor of an enterprise is always considered to be separate and distinct from the business which he controls. All the transactions of the business are recorded in the books of business though they belong to the proprietor. From the point of view of the business as an entity, and even the proprietor is treated as a creditor to the extent of his capital. The concept of accounting entity for every business determines the scope of what is to be recorded or what is to be excluded from the business books. Therefore, when our business receives cash from proprietors, cash account is debited, business receives cash and capital account is credited. Capital account represents the personal account of the proprietors. In the case of corporate bodies, since there are too many contributors of the amount is shown under a single account called share capital account. Dual aspect concept. Financial accounting is transaction based. In every type of business, there are numerous transactions. Consider trading concerns. The main activity is purchase of goods and their subsequent sale at a profit. This involves several transactions like purchase of goods from several suppliers, payment of salaries to salesmen, sale to several customers, payment of rent and taxes, electricity bill. Two aspects involved as purchase goods involves two aspects. One aspect is the receipt of goods and the other aspect is immediate payment of cash in case of cash purchases or the acknowledgement of debt to the supplier in case of credit purchase. The recognition of two aspects to every transaction is known as dual aspect analysis. Modern financial accounting is based on such recognition and recorded of two aspects of every transaction. One entry consists of debit to one or more accounts and another entry consists of credit to one or more accounts. However, the total amount debited always equal to the total amount credited. This balancing of debit and credit is the cornerstone of modern bookkeeping. Example, when Mr. A proprietor start his business with cash and building, then this fact is recorded at two places, asset accounts and capital accounts. Assets are equal capital. Assets is equal to capital. Cash building is capital. He invested cash in 20,000. Building purchase 5 lakh and 520 is equal to capital. If the business increase the asset by borrowing rupees 20,000, assets is equal to equal cash building is loan. If the business increase the asset by borrowing, he is borrowing the cash. Cash increases with capital. Cash increases with asset borrowed amount. Building capital and one account included as loan. If the business pay for furniture and creditor purchase land, asset capital, cash decreased by 5,000 and creditor purchase land increased by 8,000, and on the other hand, creditor purchase generate creditors 8,000. Thus, the dual concept can be expressed as asset is equal to liabilities plus capital. Assets is equal to liabilities plus capital. Assets, liabilities plus capital. Assets building, land, machinery, furniture, stock in trade, debtors, bank, cash. Liabilities, loan, creditors, bank overdraft, bill payables, outstanding expenses, income in advance. Business applies fund for accounting, thus these assets and meeting expenses. Business equals to land, building, machinery, goods, banks, expenses. Capital of proprietor, creditor, loan, income. Business receive fund from these sources. Business applies fund for acquiring these assets and meeting expenses, land, building, machinery, goods, bank expenses, वगैरह. Business receive funds from these sources: capital of proprietor, creditors, loans, income. Going concern concept. This concept assumes the enterprise will continue to exist in the foreseeable future. Accounting period concept. Continuity of activity to an indefinitely long period complicates the measurements of business performance. As precise result can be obtained only as on the entity's dissolutions. Accountants, however, devise timely measurements by artificially splitting business longevity into annual intervals called accounting period. Accountants, however, devised timely measurement by artificially splitting business longevity into annual intervals called accounting period. 12-month period is normally adopted for the measurement of income. Periodically also depends on the type of business for which the accounts are prepaid. Periodicity also depends on the type of business for which the accounts are prepaid. Money measurement concept. If a business may own 5 machines, 100 bales of cotton, 1000 square meter of land, and rupees 20,000, addition of these will not produce a meaningful total of what the business owns. The monetary terms express rupees 5,000 of machine, rupees 25,000 of cotton, rupees 135,000 of land, rupees 25,000 cash. The sum of rupees 235,000 depicts of the amount of owned by the business. This is why the transactions of goods and services are measured in monetary units to record and report accounting information. This is why the transactions of goods and services are measured in monetary units to record and report accounting information. Cost concept. The underlying idea of cost concept is that asset is recorded at the price paid to acquire it at cost, and this cost is the basis for all subsequent accounting for the asset. When the asset is recorded at cost price, for example, if land is purchased for rupees 80,000, then its market price, whatever rupees 170 or 5 50,000 will not be considered. Revenue recognition concept. In accounting, the amount received or receivable for the sale of output are called revenue. Revenue recognition concept. In accounting, the amount received or receivable for the sale of output are called revenue. Revenue is the gross inflow of cash, receivable, other considerations arising in the course of an enterprise from the sale of goods, from the rendering services, and from the holding of assets. Revenue is measured by the charge made to customers or clients for goods supplied and services rendered to them by the charge and rewards arising from the provision of assets. It excludes amounts collected on behalf of third parties, such as certain taxes. Revenue is measured by the charges made to customers or clients for goods supplied and services rendered to them by the charge and records arising from the provisions of assets. It excludes the amount collected on behalf of third parties such as certain taxes. Sale of goods stage. Receipt of order from the customer. Production of goods after order. Delivering the goods to customer. Invoicing and receipt of cash from customer. Sale of goods stage. Receipt of order from customers. Production of goods after order. Delivering the goods to customers. Invoicing and receipt of cash from customers. Usually, enterprise dispatch the goods to the customers and invoice is simultaneously made out. At this stage, the sale is recorded. If the goods are accepted, the sale is complete, otherwise cancelled. Usually, enterprises dispatch the goods to the customers and invoices is simultaneously made out. At this stage, the sale is recorded. If the goods are accepted, the sale is complete, otherwise cancelled. The matching concept. After the revenue recognition, all costs which are applicable to the revenue of the period should be charged against what? Against that revenue is in order to determine the net income of the business. After the revenue recognition, all costs which are applicable to the revenue of the period should be charged against that revenue in order to determine the net income of the business. This is the essence of matching concept. Next, income is usually ascertained for shorter period, usually a year. This is the essence of matching concept. Net income is usually ascertained for shorter period, usually a year. For ascertaining the net income of the year, the revenue and expenses of the year are ascertained and the following equation applied. Profit is equal to total revenue minus total expenses. Profit is equal to total revenue minus total expenses. To measure the profit for a period, it is imperative to match accurately the cost ascertained with the revenue. Accrual concept. Under this method, revenue recognition depends on its realization and not actual receipt. Likewise, costs are recognized when they are incurred and not paid. Under the cash system of accounting, revenue recognition does not take place until cash is received, and costs are recorded only after they are paid. Objectivity concept. As per this concept, all accounting must be based on objective evidences. In other words, the transaction recorded should be supported by verifiable documents.